Hey, Puppy Trades! I wanted to do a video analysis on really kind of a more impromptu breaking news thing. Of course, as many know, YieldMax's distribution, a rather large one, was paid out on January 9th. And if we look at the rest of these YieldMax distribution dates, we see it looks like they're going to continue their trend of paying not at the end of the month, not in the middle of the month, but kind of the first week of the month. So their ex dividend dates, if we look at these ex dividend dates though, we can see something very cool. Unlike a lot of the funds that typically have their ex dividend dates, kind of the last week of the month, and then they pay out their dividends kind of on the last day of the month. YieldMax has their ex dividend dates, a few days after. 4 or 5 days into the month, and then their pay date is typically after the first week. So, why is that kind of cool? Well, it was always kind of cool because as the covered call and just the dividend market itself expanded, and really it existed for a long time in the closed-in fund market. Many closed-in funds like BlackRock's closed-in funds. I'm probably going to get into those recently. BlackRock started a buyback program on some of their closed-in funds, and they've been yielding about 7 or 8%, doing kind of this partial covered call strategy. But that's not really what YieldMax and their new competitor do, right? So why am I making this video? Well, because today I actually started researching these ETFs pretty recently, and so I actually took some of the YieldMax dividends and I invested them in their new competitor. They have a competitor. I'm not jumping ship. I still love YieldMax, and as a reminder, my plan usually for YieldMax is that if there is a stock that I am bullish for whatever reason, Elliott Wave, fundamentals, something that I think the New World Order is whispering, or whatever, then I, especially if they have higher implied volatility, a stock like Coinbase, a stock like Square Cash, AI, then those synthetic covered call positions are going to get very high monthly premium. Now, I don't just like to chase the high premium and the high yield. Chasing the high premium and the high yield in the kind of the synthetic covered call market is very dangerous. That's where we get to a different ETF that's competing with a different class of not covered call ETFs, but zero DTE ETFs. Yes, those ETFs have a new competitor. We're going to get into their competitor too. But just getting back to the synthetic covered calls on the growth, one reason that I don't just go, and chase Tesla and Square Cash SQY and AIYY, AIs and Coinbase, Conies, and those really high, Modernas. I like, some of those that I just mentioned. They have the highest implied volatility, so generally they're almost always going to have the highest dividend yields. Now, it's also important, very important for me to have fundamental kind of assets backing my portfolio. Now, Disney's a controversial stock, ExxonMobil, maybe less so, but that's also why I like to get those, kind of aspects of YieldMax where they got maybe that 20% implied volatility, so they yield about 20 to 25%, but instead of, Coinbase and, its crypto assets, or, well, for the reasons that the bears think Nvidia and Tesla might be overvalued, the valuations of Disney and ExxonMobil are a lot more backed by fundamentals. But anyway, that was just a note on that. The big shebang of all this is that TSLP, and the whole list of them is right here, that Curve has AMZP, Apple's, Amazon's, Google's, Microsoft's, Netflix, and Tesla's. Really, the two that I'm most interested in right now are Tesla's, and the one that I'm most interested in, to be frank, is Netflix's, because I didn't buy as much as the Netflix YieldMax ETF. And generally, when I am bullish a YieldMax fund, what I like to do is over time get the actual shares underlying and blending that with the covered call holdings, because the synthetic covered call holdings, they don't actually own the underlying stock. Now, these are a little different. They do say it sometimes they will buy shares, but for the most part, just to summarize, what these funds are doing is that they are using their advantages of having European style options in their buying a call, and they're buying an at the money call, and they're simultaneously selling an at the money put. So buying an at the money call typically is going to have a delta of 50. Selling an at the money put is going to have a delta of it's going to be a negative 50. So it's also going to be 50, two negatives, negative positive. So it's going to be the equivalent of owning 100 shares. Now, selling at the money puts is extremely dangerous. That's why YieldMax and I believe Curve, they're selling European style puts, and those cannot be exercised until the last day. So then what they do is they take that 100 delta equivalent position. That's why it's called a synthetic covered call, because they don't actually own 100 shares. They save money by buying the call, selling the at the money put, and then what they do is they sell out of the money calls against that position, usually about 5 to 10% higher. So, and typically expiring about 1 or 2 weeks. Just to summarize what these ETFs are doing, again, read the prospectus as always. I certainly have and am going to keep doing it. But the whole big shebang in making this video is a few things. One, the ones that I'm interested in, Netflix's and Tesla's for Curve have outperformed them. So let's get into the big devil's advocate. What's the big devil's advocate here? Really, the biggest devil's advocate that I think is most legitimate. You know, people are going to have opinions on the underlying stocks. Are they bullish or bearish? Will the synthetic covered calls work to capture the, volatility and, even in downside? And anyway, there's going to be debates about that. What I think is the actual biggest devil's advocate for these is that the expense ratios, the expense ratios for these funds are nothing to sneeze at. If we look right here, its gross expense ratio is 1.15, and the only reason it's paying YieldMax's expense ratio right now, which is 0.99, appears to be because they have an expense ratio fee waiver. So they may have more information on how long that fee waiver is expected to last. We can see their holdings right down here, again, almost identical to what YieldMax does. They've got cash and equivalents and treasury bills, and then they're running synthetic out of the money covered calls. On Netflix, we can see the strike price for their synthetic position is 500, and it expires for April. So this is really cool. I don't mean to geek out, but what they're doing, just let me geek out a little bit. They are taking advantage of an option decay dynamic, basically where theta decay increases exponentially as the strike price approaches. So what they've done, this is kind of cool, they took a synthetic covered call position for the 500 strike for April 19th, and notice that they're using the most liquid expirations. Even people who don't know or don't trade options, in my unprofessional opinion, it's pretty ignorant to not want to know when these big expiration dates are. And, reading a few prospectuses of these funds, pretty clear. But anyway, what they're doing, they're selling a synthetic. I think this might be a much shorter time frame than YieldMax's. So that I might dive deeper into why. Maybe this might be explaining the outperformance, because I think YieldMax is doing further expiring. Anyway, they have a further expiring synthetic position. So they're getting their 100 delta. A synthetic covered call has to have 100 shares exposure. Okay, to sell a covered call against it, that means it's covered by a delta equivalency of 100 shares. So they got that delta equivalency with the 419 expiration, and now notice they're taking advantage. This is really where the quant side of it gets in. What they're taking advantage of is the fact that these options up here, what they're selling It's actually very kind of cool how we can see exactly what they're doing. They've bought 11 500 calls on Netflix, and they've sold 11 500 European style puts. That's given them a synthetic long position, and then they've sold 11 covered calls against that position. But notice these strike prices they're selling, they're much further out of the money. It looks like these, I don't have, that's about 12% out of the money. 500 divided by 545. I think that's a little less. Yeah, it's about 9%. 9% out of the money. That's about 9% out of the money. And they expire 2 months before the synthetic position. So they're selling generally what these, the rule of thumb that these, option sellers like to do. They like to, their kind of cheat sheet is to sell a 30 delta call. That means it has a 30% chance of expiring in the money at the time of expiration, and they like to sell it that expires in 30 days. So it's kind of like their little 30-30 rule of thumb. They're selling an option that expires, 30 to 45 days. It looks like it's about 9 to 10% out of the money. And then these options, what's important to know, these options are going to have rampant decay relative to these options. Anyway, that's all honestly just kind of jibber jabber because I'm not a certified financial advisor. What might be a little more, and while this isn't really the only thing to note about these stocks, what I think is cool is, here's what's really cool. Both of these ETFs have had their distributions. They've had their distributions, and we can see their future distributions are after the YieldMax pay dates. That's the whole shebang. That's why I made this video. Their ex-dividend dates are all after, at least so far, they're all after the YieldMax pay dates. That means that for the same expense ratio, running what's basically the exact same strategy, it can now compound twice as fast. That's the whole shebang. Because these ex-dividend dates are 3/20. These pay dates are the 9th of the month. So if this pattern continues, we'll have a situation where this synthetic covered call strategy, which is yielding quite high right now. I'll get these actual yields. Let's see. What's YieldMax quoting their own yields? They're quoting, let's see what they're quoting their own yields right now. That might be a good idea. 19% yield is what they're quoting for their forward, it looks like. Tesla, theirs is yielding about 27%. So YieldMax, we'll see. I mean, it has a lot more trading history. And I would say another thing that does kind of matter is that the gross expense ratio is 1.15 and the net expense ratio is 0.99. That means over the long term, it kind of looks like what they're saying is, this is what the real expense ratio is, and it might just be lower because these are new products. And that's really the big fear with getting too caught up in my opinion, getting too caught up in just these high yielding synthetic funds, in any one fund for that matter. Getting too caught up in the Defiance ETFs or getting too caught up in one fund manager is a big part of the diversification thing for me. One thing I really like seeing is that the Bali ETF, BALI, FEPI, FEPI, and some of these other funds that have come from Morgan Stanley, PAPI, PAPI, that are doing these covered call strategies, they're getting their expense ratios down to where JP Morgan's is kind of closer to. JP Morgan's JEPI and JEPQ, their expense ratio is 0.35. That's extremely kind of good, in my opinion. That's very favorable. The closer an expense ratio is to 1 or above, 1's kind of the line in the sand. That's kind of the Rubicon. And so it looks like this fund family is saying, hey, we're, how much better is the performance, then YieldMaxes will see. Right now, it's kind of compelling because they're running again a very similar strategy. So I'm going to, try to dig in and figure out what's kind of the cause of this strategy. Let's see. Let's get it as far as we can. So if we look, this is the curve yield, 65% return annualized versus Netflix's for YieldMax over the same time period. It's lower, 7% lower. It's about 7 or 8% lower. But the other cool thing is that they're basically running the exact same strategy, and now this yield can compound twice a month just because of how big this arms race has gotten, where their distribution dates line up perfectly. It appears right now that the pattern is going to be curve. Their ex-dividend dates are at the end of the month, seemingly well past YieldMax's pay dates, which are at the beginning of the month. So that's really, where I was going with that. The other one, just to compare to performance, TSLP all time. We've got 84% versus Tesla. Again, this outperforms, the lump sum running the exact same strategy by about 9%. And again, I think the bigger thing is we'll see. These funds have only been out for a few months, right? That's what I'm trying to say. YieldMax is a little more proven. YieldMax has some banger ETFs that have done some pretty amazing things. And for the vast majority of, retail history, what that period NVIDIA's gone through has not been really the most profitable, thing on the buy and hold. But YieldMax allowed that huge consolidation period to be pretty profitable, selling synthetic covered calls. If we look at MSFO, I was not as big of a MSFO guy as I should have been. They smoked this. I mean, this is done pretty well, selling covered calls on Microsoft. This is the biggest holding with Apple on almost every, basically every market index fund. This is the biggest holding, and YieldMax made an ETF that's been doing a pretty impressive job. And, obviously the timing of them releasing these ETFs, I'm still getting a little conspiratorial. Let's see, when was MSFO's release date? Did they really not release MSFO until August? That's wild. I think AMD's done pretty well. But anyway, YieldMax is a little more proven. Curve is the new kids on the block. And, they're outperforming right now. They seem to think that their outperformance is going to be worth, right now they're being nice. Hey, we'll see why they're saying this is the net expense ratio. That's typically because of a fee waiver. Anyway, I think you guys knew where I was, going with that. The other thing I wanted to get into is this. Oh man, speaking of expense ratios, so I made a video recently about JEPY and QQQY. They sell 0 DTE puts on cash secured puts on the NASDAQ and the S&P 500. That is not what this strategy is. And I want to do a more in-depth video on this. But here it is. The iSpy S&P 500 high income. The first ETF powered by a daily covered calls. So daily covered calls. And what's awesome about this fund, one, the expense ratio is 0.55, very cheap. The 0 DTE aspect really makes it's very compelling what this ETF could be doing, because 0 DTE didn't even exist for a while. The widespread covered call market just being super available and there being an arms race in it, that's relatively new. That's as new as zero DTE. Now there's a zero DTE covered call ETF on the S&P 500 for 0.55. I would be I honestly would be very surprised personally if this did not end up outperforming the S&P 500, because this is going to sell a zero DTE option every day. And I don't know. Maybe it won't outperform the S&P. This is new. This is brand new right off the block. And they're not even using, what's crazy, they're not even selling options themselves. They're using swaps that are backed by Goldman Sachs. So they're using Goldman Sachs swaps. They haven't paid a dividend yet, so there's no way to have a clue. Yeah, no distributions for this fund, but they want to pay monthly dividends running a zero DTE covered call strategy on the S&P 500. The expense ratio is 0.55. It's ProShares. I mean, we'll see. The strategy is to have selling zero DTE options for income and target S&P 500 returns over the long term. A higher return potential. Where are there? Let's see. Yeah, I digged into this a little bit. Yeah, that expense ratio 0.55. The fund invests in financial instruments that ProShares advisors believe in combination should track the performance of the index. The index is designed to replicate the performance of an investment strategy that combines a long position in the S&P 500 index with a short position over here in S&P 500 index call options. This combination is often referred to as a covered call strategy. Generally, in pursuing a covered call strategy, an investor holding a certain security sells or writes a call option on the same security in an attempt to generate additional income. In particular, the index is designed to replicate a daily covered call strategy that sells call options with 1 day to expiration each day. Daily covered call in S&P 500, daily covered call strategy seeks to generate high income with total return and risk similar to the S&P 500 over the long term, compared to a similar strategy using monthly call options. ProShares Advisors believes a daily covered call strategy provides greater total return potential over the long term. The seller of a call option receives a payment premium from the buyer. In this way, a covered call strategy provides an investor with additional income in the form of an option premium. In the form of option premiums, the seller is obligated to sell shares of the underlying security to the buyer at a specified price, strike price, at a specified date, the expiration. At the expiration, if the price of the underlying security is above the strike price in the money, the buyer will exercise the option, benefiting from the ability to purchase the share from the seller at a price lower than the current market price. If the price of the underlying security is lower than that at the strike price out of the money, the option will not be exercised, benefiting the seller who retains the shares. Let's see. Yeah, that's just saying what's in the S&P 500. The short component of the index consists, so they're long the S&P, that's what that says. The short component of the index consists of out of the money S&P 500 index call options having 1 day to expiration. At the end of each day, the options are traded on National Securities Exchanges. The fund will not write, so this is an important distinction, the fund is not writing the daily call options, but instead will obtain exposure. So this fund doesn't even have exercise risk in theory. They really only have counterparty risk. The fund will not write daily call options, but instead will obtain exposure to the component of the index through swap agreements. The fund intends to make distributions each month of an amount that generally reflects the dividend and call premium income earned by the index net of fund expenses as measured by the S&P 500 daily covered call index. So I'm going to look into that. So this is another thing. In income only, subdex index that measures the cash received from the index from dividends and call option premiums. The monthly distributions are intended to provide shareholders with dividends and call premium income. However, a significant portion of the monthly distributions may be characterized as a return of capital. So that's where it's important for me to say there are going to be important tax implications in this. I'm going to look more into this index itself, and there are going to be, you know, generally it's my understanding that return of capital is a more or less positive thing. As long, you know, but there's very important nuances, and you know each state's tax laws is different. And while I'm not a certified financial advisor, I am 100%, definitely not a tax professional. So I will leave it that with that regard. But zero DTE. I mean, think about all those times we hear about chop now, chop, chop, chop. Now, I mean, there's an ETF. There's two ETFs where the compounded synthetic covered call strategy on Apple, Google, Tesla, Netflix, all those big FANG stocks and probably more, that's just going to be, you know, something that can be compounded bi-weekly, you know, running the exact same strategy. So I think that's pretty crazy. Now, I Spy with JEPI is going to, for in you know, if I Spy, in theory, was paired with JEPI, which I'm not saying is a good idea, I'm just saying in theory, there's endless possibilities now with all types. Even the fact that Put W is selling, you know, options that are far away, about, you know, 2 or 3 weeks away. There's plenty of ETFs that sell, you know, covered calls that expire in 1 month, you know, but just the idea that JEPY, you know, half of that, the zero DTE put ETF combined with SPYI, you know, combined with I Spy, not SPYI. That's going to take a habit to change. JEPY sells zero DTE puts. I made a video about QQQY. JEPY sells zero DTE puts on the S&P 500. That has an expense ratio of 0.99. I Spy has an expense ratio of 0.55. That sells daily covered calls on the S&P. So we're going to be able to find out what the yield on that's going to be. But right now it appears that potentially one of the endless possibilities is that a zero DTE straddle could be sold on the S&P 500 every day for an expense ratio average of about 0.75. You know, right now for an expense ratio of 0.99, synthetic covered calls on all those big FANG tech stocks everyone loves can be compounded bi-weekly. And that's just one of the possibilities.